How do you buy shares in South Africa? What are the top 3 most common mistakes done by DIY investors when they start buying shares? And what lesson can be learned from those mistakes? Please do ensure to subscribe to my YouTube channel, click on the notification bell and like this video. So let's get into it. Hello there, I am Ivan Sambo and welcome to my YouTube channel. On this channel we talk about everything personal finance, self-development and law. Today I'm answering 3 questions which are: how do you buy shares in the context of South Africa as a DIY investor, a do-it-yourself investor? What are the top 3 most common mistakes done by DIY investors when they start investing in shares? And also, what are the lessons to be learned from those mistakes? Please do know that I'm not a registered financial advisor and all my videos and all the content I put out is just for educational purposes. So do not say I gave you financial advice, it's just for educational purposes. So let's get into the first question. How do you buy shares in South Africa as a DIY investor? The most simplest way and the simplest answer is easy equity. There are a lot of stock broking platforms in South Africa. Some of them are offered by banks, some of them are offered by other companies, but one of the most simplest, easy to understand one is easy equity. Just go to your Google store, search easy equity, download the app or go to their website easyequity.co.za and you can start trading just like that. You just sign up, put your information there, get fee card, and then start trading, make your deposit, and you can start buying shares and investing into shares at any amount that you have. The platform is easy to understand. They're not using big finance jargon and investment jargon, so the English there is simple, broken down so that me and you can understand it. So that is one of the best and easiest way as a DIY investor you can invest into shares. I always recommend easy equity. My portfolio is on easy equity. My shares investment is on easy equity. So that's one of the most easiest way you can invest into shares or can buy shares in the context of South Africa as a DIY investor. Below I will attach a link to one of the trends which I have done and simplify every step of registering or into buying shares within easy equity and how you can do it, and some of the things which are hard to understand I break them down there. So I'll attach the link below which goes deep into easy equity and how to buy shares within the context of South Africa. So moving right along to the second question, which is, so what are the top 3 common mistakes done by DIY investors when they start investing into shares? I'm sharing this information or these mistakes because myself, I have done them myself, and I had a chat with few of my friends within my network and I asked them to give me their top 3, and almost all of them have these mistakes and they've done them when they started investing into shares. So the first one, I think I'm speaking from experience when I talk about this, is not doing enough research. And I think especially for me, let me share my story. When I started investing into shares through easy equity, the first mistake I done was by companies which are common. I bought Shoprite, I bought Standard Bank, I bought Mr. Price. I think I also bought a little bit of, I also bought Tokosang. Yeah, I also bought Tokosang. No, I didn't buy Tokosang. I think I bought Tokosang. No, I didn't buy Tokosang, man. I bought Tokosang this year. But anyway, I don't remember the 4th company I bought. I remember I bought 4 companies when I started investing in easy equity. Then the mistake of me doing that is that I didn't do my research on those companies. I know them, but I don't know their financial situation. I don't know in terms of the market where they are standing, how they were performing last year, how they're performing last week or 2 months back. I didn't know that. I didn't know anything about them besides that I use them and I go to shop there. I go to ShopRite when I need food. I'm a Standard Bank customer, so I use Standard Bank. That's the only thing I knew. So that's the first mistake that everyone do. And the way to fix that mistake is I'm a big advocate of using MoneyWeb. MoneyWeb gives you articles about particular companies that you're looking for. You'll find articles about them there. So if you are particular, want to buy a company, you want to buy Salesforce, for example. I'm not saying buy Salesforce, I'm just using an example because everyone talks about them on Twitter. So you want to buy Salesforce, for example, go to MoneyWeb, check out articles published about Salesforce. What are they saying in those articles? If you want to buy ShopRite, go and search ShopRite, Google them. There are a lot of websites which you can use that will provide you information, articles, opinion pieces, like so much information. So when you're done reading that information and you consume that information, you can sit down and say, okay, here's the information I have in front of me, and what's my conclusion? Do I buy this company or I just move on? So that's the thing that you need to do for yourself. So the second mistake which DIY investors do is that they go for individual stocks when they start investing. Here's the thing, I also suffered to that. So I'm sharing something that's experienced to me when I started investing. I also bought individual stocks. I said I bought 4 companies when I first time purchasing shares through his equity. It was just 4 companies and they were individual stocks. And when we talk about individual stock, we're talking about buying shares for a particular company. For example, ShopRite. So I buy shares from ShopRite and buy ShopRite shares. I'm buying individual stock because that's just shares for ShopRite alone. And that become risky because ShopRite perform bad. That means my portfolio is bad. But if I go and I buy a basket such as an ETF, which I will link below, I tried to one of the that explain ETF much more in depth. But for general understanding now, ETF basically is a basket that has so much stocks into which commodities. Some have commodities, like have so many underlying assets under it. So basically, when you buy that ETF, you're buying a basket with so much into it. Like for example, if you buy an ETF that tracks at the top 40 performing companies, that means you're buying all 40 of those companies by just buying that one single ETF. So out of that 40 companies, if 2 do bad and the other 38 do good, obviously your ETF will do good because that means the 2 will be overweight by the other 38 which are doing perfectly good. So that means your ETF will be good. That means your risk is spread toward all those 40 companies. If one does well, the other 39 will cover them. Will cover it. So your ETF will be good and your investment portfolio will be good. So as a beginner, as a startup DIY shares investor, it's good to start with your ETF. I always advise that. I did not do it myself. I learned that 3 weeks after investing when my mentor was like asking me, hey, how did you go with your buying of shares for the first time? I was like, yo, I bought 4 companies. I was like, So he advised me like go for your SPS 500, go for them, like go for your Nasdaq, go for your ETF, like look for them, look for the one that works for you. But also linking into the point number 1, research. So you also need to research, you need to find the fact sheet of that ETF that you're buying. You need to know what is inside it, because some ETF you'll buy and you'll find out it's made out of 30% one company, for example, of one ETF having 30% into Facebook as an example, other 20% into Apple, and the other 3% into Microsoft. So if those 3 companies do bad, the entire ETF will do bad. So you need to also look into the fact sheet of the ETF that you're buying. I'll link below in the description a link to ETF Central, which gives you all the information about ETFs. So you can be able to, before you buy your ETF, to get that information. That's the second mistake that DIY first time shares investors do, is to buy individual stock. So I always say, buy ETFs when you start investing. Buy your top 40, buy your SP 500, whatsoever ETF that you find good for you. And the third mistake, but before we go to the third mistake, I want to give you guys another tip, is to always create a watch list for your shares. You can create a watch list using investing.com. Is free. You can go to investing.com, register there, create your watch list and track all your stocks there. So you can be able to understand what your stock, how your stock is doing for the day, how much did it lose, how much did it grow. So you can be able to also set alerts and everything, and able to watch and see your investment, and also get articles about the company, for the company that you have, and be able to say what the market is saying, able to see what the market is saying about your company. So that's a good tip to have. Create a watch list for yourself, create an investment portfolio for yourself using investment.com, and also name your portfolio with your goal. I named my investment portfolio 1 million rand because I want to grow it and see it being 1 million within the next 5 years. I want to have that 1 million there. I know it's hard, but I'm not worrying about how I'm gonna do it. I'm to only know that I will reach that. So moving on. Moving on to number 3 of the most common mistakes done by DIY first-time investors is also getting nervous. I remember when I started buying, I also got nervous when I log in the next, because I bought today, I log in tomorrow morning, I check my portfolio at Easy Equity. Yeah, I got worried because one of my company was down. Was down by, I think at that time was like by 3%, but I got worried because I'm a first-time investor. I got nervous. But it's so important to understand that shares go up, down, every single day. But when you invest and you're a DIY investor, you invest with long term. You invest knowing you are investing for the next 5 years, for the next 20 years, for the next 15 years, whatever your goal is as a DIY investor. In a previous video, I did mention that it's important to always have a goal and know what you are investing for. I will link that video in the suggestion card above, so do check that video out. But it's so important to have your goal, so you understand that if your shares go up and down every day, you don't get worried because you understand the long-term goal you have for that portfolio. And also, if you are diversified your portfolio investment, you have shares throughout all sectors, and you have ETF that spread also international and not only bound within South Africa, you can be able to sit comfortable and just watch. Just look at your watch list if you're using investor.com, and just look at those numbers go blue, go blue, they go red, they go blue, and just look at it and just understand, just look without getting worried. So that's one of the important things to do as a DIY investor, to never get worried. So you don't need to get nervous. Sometimes just chill and look, because if you have 50 shares in a particular company, you'll wake up with 50 shares. The value may go up, may go down, but you still have 50. So if one thing we have to know and remember, especially those who remember the 2008 economic crisis, that the market always recover. The markets will always recover. So if your shares are diversified as a DIY investor on all sectors, and you have ETF, you have offshore, you have all of those things, like you diversified your portfolio, you know when the market recover, you will be celebrating. And when things are bad, it's always good to buy. So remember, it's always good to buy low and sell high. So as a DIY investor, it truly is important to know that. Never get worried. So just a recap of the 3 lessons that we need to know, and the 3 mistakes that we need to know. And number 1 is always do your research. Number 2, always ensure you don't buy individual stocks and have your portfolio made up of mostly individual stock. Have ETF there. Have like diversify your portfolio. Like, it's so important to diversify your portfolio. Number 3, always don't listen to the noise. The noise will be there. People always make noise. And remember, like as I said, I shared my story about the alcohol ban. Like, don't make noise. Just keep calm, keep collected, know your story, know your goal. You know why you are investing. So do not get worried by opinions of people. If you have done your research, your portfolio is diversified, the noise, let them make noise. Thank you so much for watching my channel. Please do ensure you like this video, subscribe, and also share it. Thank you so much. I am Ivan Sambo, your student investor.